Today, all eyes are on the Federal Reserve, the nation's central bank, and arguably one of the most influential institutions in the world of finance. Whether you realize it or not, the decisions made inside this building ripple out to every corner of the country, touching the lives of millions of Americans every single day. The Fed is a powerful force in your financial life, shaping everything from the cost of your mortgage to the stability of your job. Its influence extends far beyond Wall Street, reaching into the daily realities of families, workers, and business owners. Its main job? To keep the economy stable. That means making sure there are enough jobs for Americans and that businesses can grow and hire. The Fed's mission is to create an environment where people can find work, earn a living, and plan for the future with confidence. It also works to keep prices from spiraling out of control, so your paycheck goes further at the grocery store and your savings don't lose value overnight. Price stability is crucial for families trying to budget and for businesses making long-term plans. The Fed's most important tool is the federal funds rate, the interest rate banks charge each other for overnight loans. This rate might sound technical, but it's the foundation for borrowing costs across the entire economy. When the Fed changes this rate, it sends shockwaves through the financial system, affecting everything from your credit card interest to your car loan, your mortgage, and even your paycheck. It's a lever that can speed up or slow down economic activity. Raising rates makes borrowing more expensive, which slows down spending and investment. This is the Fed's main weapon against inflation. When prices are rising too fast, higher rates can help cool things off, but they can also make it harder for people and businesses to get loans. Cutting rates does the opposite, making loans cheaper, encouraging people to spend and businesses to invest. Lower rates can jumpstart growth, create jobs, and help the economy recover from slowdowns. Today, September 17, 2025, the Fed is expected to announce its first rate cut of the year, a major shift after months of holding steady. This decision is making headlines because it signals a new direction for the economy, and everyone from Wall Street traders to Main Street families is watching closely. This isn't just a headline, it impacts your loan payments, job prospects, and the health of businesses everywhere. The Fed's move will influence how much you pay on your credit cards, whether your employer can afford to hire, and how confident businesses feel about the future. The reason for this shift? New data shows the job market is slowing down fast, with fewer new positions and more people searching for work. The Fed is under pressure to act quickly to prevent a deeper downturn and support those who are struggling to find employment. But inflation is still higher than the Fed wants, putting them in a tough spot. Cut rates to help jobs and risk higher prices, or keep rates steady and risk a recession. It's a delicate balancing act, and there are no easy answers. If the Fed moves too quickly, it could fuel inflation and make life more expensive for everyone. But if it waits too long, the economy could slow even further, leading to layoffs and business closures. The choice the Fed makes today will reveal what it fears most and shape the economy for months to come. The stakes are high, and the impact will be felt in every household, every business, and every community across the nation. The U.S. economy is at a crossroads, pulled between two conflicting goals: maximum employment and stable prices. These two priorities are at the heart of the Federal Reserve's mission, but right now, they seem to be working against each other more than ever before. Right now, the job market is weakening while inflation remains stubbornly high. Businesses are slowing their hiring, and many Americans are feeling the pinch as prices for everyday goods continue to climb. Recent reports show companies are hiring less, unemployment is rising, and workers are worried. For many families, job security is no longer a given, and the fear of layoffs is growing. At the same time, inflation ticked up to 2.9% in August, well above the Fed's 2% target, thanks in part to new tariffs making imports more expensive. Rising costs for food, fuel, and housing are squeezing household budgets across the country. The Fed's usual playbook is to raise rates to fight inflation, but that could make the job market even worse. Higher rates mean it's more expensive for businesses to borrow and invest, which can lead to even more layoffs. If they cut rates to help jobs, they risk fueling inflation further. Lower rates might boost hiring, but they could also send prices soaring even higher, making life harder for everyone. It's a classic dilemma. Focus on jobs and risk higher prices, or fight inflation and risk more layoffs. There's no easy answer, and every choice comes with trade-offs that affect millions of people. The Fed must choose the lesser of two evils. knowing either path will have big consequences. Their decision will ripple through the economy, impacting everything from paychecks to grocery bills. This decision will shape the economy for the rest of the year and beyond. The effects could last for years, influencing how Americans live, work, and spend. The stakes couldn't be higher. Every American, from business owners to workers to families, will feel the impact of what the Fed decides next. The Fed's next move will reveal which risk it's most willing to take and set the course for the nation's economic future. The main reason for today's expected rate cut, it's not just about inflation or global uncertainty. There's a deeper concern at play. The labor market is flashing red, sending a clear signal that trouble may be brewing beneath the surface of the economy. August's jobs report showed just 22,000 new jobs, far below expectations and a sign hiring is stalling. Economists had hoped for a rebound, but instead, the numbers point to a worrying slowdown. For the first 8 months of 2025, only 598,000 jobs were added, compared to 1.4 million last year. That's less than half the pace, and it's raising alarms across Wall Street and Main Street alike. The slowdown is real. The U.S. even lost jobs in June, a rare and troubling sign for an economy that's supposed to be growing. Unemployment is now at 4.3%, the highest since 2017, excluding the pandemic spike. That means more Americans are struggling to find work, and the safety net is being tested. Fewer jobs mean fewer opportunities and more families feeling the pinch. Everyday people are tightening their budgets, worried about what comes next. The Fed's mandate is maximum employment, and these numbers are impossible to ignore. Policymakers are under pressure to act before things get worse. High interest rates meant to fight inflation are now weighing on growth and hiring. Businesses are pulling back, and job creation is slowing as a result. That's why the Fed is pivoting, cutting rates to try to stop a weak job market from turning into a recession. The stakes couldn't be higher. The hope, a small cut now, can prevent bigger problems later. It's a calculated move, aiming to steady the ship before the storm hits. But the risks are real, and the Fed knows it's a gamble. If they move too slowly, the damage could be lasting. Too quickly, and inflation could return. The labor market's warning is loud and clear. It's a wake-up call for policymakers, businesses, and workers everywhere. The Fed is listening and acting, hoping their next move will keep the economy on track and avoid a deeper downturn. Even as jobs slow, inflation is proving stubborn. After months of improvement, inflation has crept up from 2.3% in April to 2.9% in August. New tariffs on imports are pushing prices higher, making everything from electronics to groceries more expensive. The Fed's usual response to rising inflation is to raise rates, not cut them. But with the job market weakening, the Fed faces a classic stagflation dilemma: stagnant growth and rising prices. Any move risks making one problem worse. Cut rates and inflation could accelerate. Hold steady and unemployment could climb. Chair Powell is forced to prioritize jobs or fight inflation. Today's rate cut signals the Fed is more worried about recession than persistent inflation. It's a tough call with no easy answers. So why cut rates now? The Fed is trying to get ahead of a downturn before it spirals. Lower rates make it cheaper for businesses to borrow, invest, and hire, hopefully putting a floor under the weakening job market. The Fed's focus has shifted. Inflation is still a concern, but rising unemployment is now the bigger threat. A small cut is a cautious first step, not a return to ultra-low rates. Chair Powell will stress that future moves depend on the data. The goal, just enough stimulus to support jobs without reigniting inflation. It's a recalibration, not a panic. The Fed is threading a needle, trying to boost growth while keeping prices in check. The stakes are high and the path is narrow. The next few months will test whether this balancing act works. Cutting rates is a double-edged sword. The reward cheaper borrowing for businesses and consumers, which could boost hiring, investment, and spending. Lower rates mean lower payments on credit cards, car loans, and mortgages. Good news for many households. But the risk is real. Cheaper money could reignite inflation, eroding your purchasing power. If inflation takes off, the Fed might have to reverse course, creating more uncertainty. There's also a chance the cut won't work. If businesses and consumers stay cautious, cheaper loans may not spur much activity. The Fed can make borrowing easier, but it can't force people to spend. If the cut fails, the Fed loses a key tool and faces even tougher choices ahead. Every move has trade-offs. The outcome is far from certain. The Fed's decision isn't made in a vacuum. It's under intense political and internal pressure. President Trump and his team are pushing for bigger, faster cuts, blaming the Fed for slow growth. The White House has even targeted specific Fed officials, raising questions about the central bank's independence. Inside the Fed, there's deep disagreement. Some want bigger cuts to help jobs, others want to hold rates steady to fight inflation. New Trump appointees may push for more aggressive action, while others urge caution. Multiple dissents in today's vote would signal just how divided policymakers are. Economists are split too. Some say the Fed is right to prioritize jobs, others warn it's a risky bet with inflation. The lack of consensus shows how tough this moment is to navigate. The Fed's credibility and independence are on the line. Every decision is under the microscope. What does a Fed rate cut mean for you? In short, cheaper loans, but lower savings returns. Expect lower interest rates on credit cards, auto loans, and possibly mortgages, making big purchases a bit more affordable. Mortgage rates have already started to fall, which could help homebuyers and boost the housing market. But savers will feel the pinch interest on savings accounts and CDs will drop, cutting returns for retirees and anyone relying on interest income. It's a trade-off. Borrowing gets easier, but saving gets less rewarding. The Fed's goal is to support jobs and prevent layoffs, but if inflation rises, your paycheck may not go as far. The impact on your wallet depends on how well the Fed manages this balancing act. Watch for changes in your loan rates and savings yields in the coming weeks. The effects will ripple through your finances, sometimes in ways you don't expect. The Fed's move touches every American one way or another. Stay alert to how it affects you. Today's rate cut is just the start of a new, uncertain chapter for the U.S. economy. The Fed is taking a cautious step, but no one knows what comes next. Markets expect more cuts this year, but the Fed may move slower if inflation stays high. Every jobs report and inflation reading will shape the Fed's next move and the direction of the economy. For now, financial caution is wise. Build savings, avoid risky debt, and watch the data. The Fed is prioritizing jobs, even if it means tolerating higher inflation for a while. Whether this gamble pays off remains to be seen. Political pressures and global uncertainties add to the challenge. The Fed's actions will shape your financial future. Stay informed, stay prepared. The story is far from over.